Good morning and welcome to the morning market review. It's Thursday and it's the 28th of September. My name is Russell Shaw. I'm a senior market specialist at FXCM, and I'd like to draw your attention to my email address, which is rshaw@fxcm.com. Let's go ahead and bring up the disclaimers, and we'll keep these on screen for a few moments before we begin the webinar. Good morning, Matthijs. Pleasure to have you on the webinar. Thank you for joining. Good morning, Kim. Thank you for signing in. Pleasure as always. Hello, James. Welcome. All right, let's just bring up the market commentaries disclaimer. Good morning, Raj. Pleasure to have you on the webinar. Thank you very much for signing in. And just finally, our references, MarketScope 2.0 and TradingView.com. Right, let us start off with TradingView. Let us take a look at that real rate. And again, the question that we need to ask is, how high can rates go? Yesterday, this is the day chart. So yesterday we had a fairly strong day on the rates. And this is all happening when the RSI is overbought. Okay, so I just want to fix up the border here. That's better. So here you can see this green rectangle is what we're referring to when we say that the yield is overbought. How high can the yield go? Because it's really a key driver of the market at the moment. And I suspect that we are pretty close to some sort of ceiling here, at least until there is a pullback in the RSI. It normalizes below 80. The theme, or I guess the idea that is driving real rates, is the fact that the Fed is now keeping rates higher for longer, and that is what's been reflected in the real rate as it moves up. But the real rate is affecting the markets. And what we're going to do here is the first chart we'll bring up here is NASDAQ. We did take a look at this yesterday. NASDAQ, as we head into Q4, next week's Q4, it's the last quarter of the year. Okay, we've got the NASDAQ, which has now charted a lower peak and a lower trough. That puts the NASDAQ into downtrend. The key driver of the NASDAQ, the NASDAQ performed extremely well for the first 6 months of 2023, and then it's had a poor third quarter. And the key driver, so there was opposing forces. There was higher interest rates, and then there was the artificial intelligence narrative, and that artificial intelligence narrative was stronger, more powerful than the yield. That's really what drove the markets for the first 6 months of this year. It seems as if now the narrative has changed. It seems as if the yield is now the more powerful force, and we want to monitor that because as traders, it is going to have an effect on the positions that we take. What I'm looking at with regards to NASDAQ, first of all, is this exponential moving average. I'm using that as a potential support level, but it's not only the exponential moving average that's the support level. Truth be told, we actually have a price support level here as well. So there's this key support that is almost an overlap of EMA support with this price support. If we break below it, well, that is the bearish That is the bearish, the next bearish signal. If we drop below this green support, if we drop below the exponential moving average, and the exponential moving average moves down. So let's just see if the support level holds. It may. Why would it? Because remember, if we go back to our real rate, the real rate is overbought. Okay, so if we get some sort of respite in the real rate, if we see some sort of pullback in the real rate, then I think the support level in the NASDAQ tends to hold. Okay, but we've got to wait to see if that happens, right? If we take a look at NASDAQ on the daily chart, you can see that it is in zone 3. Zone 3 is our bearish area. It's between the lower blue and the lower red. Yes, we're at this support. You can see that we do have a negative momentum as well. Take a look at the Bollinger's. There's something ominous taking place with the Bollinger Bands. You've got an initial expansion in the Bollinger's. That's as the volatility increases. Okay, so they push apart, and then what's happening now is they're starting to pull together. So you can see the top Bollinger has curled down, and that is a dangerous signal, because if it starts moving in this southeasterly direction and the lower band is moving in that southeasterly direction, well, that's a trend. That's a trend. So it's really now a matter of, does the support kick in and does it hold? So something that we've got to monitor. The reason that we're looking at NASDAQ is because it's probably the index that's most sensitive, to interest rates. And remember, those interest rates are at overbought levels. I'm just going to go mute for a moment. There's a cough coming. I beg your pardon. Excuse me. All right. So that's the NASDAQ. Let's take a look at the S&P 500, but I'm going to look at the S&P 500 on TradingView, because we're going to look at some extra information here. Just bear with me. I'm going to overwrite the real rate, and let's just go put in SPX 500. So we're looking at the FXCM CFD for the SPX 500. We'll bring that up, put it on weekly. All right, and what we have here is a similar looking chart to the NASDAQ. We've got a lower peak followed by a lower trough. That puts it into downtrend. I can't put in the 30-week moving average. I think let's just put that in for the sake of completion. So go moving average exponential. Okay, and what I'm going to do is just adjust this. We'll make it 30 and just change it to black. Okay. All right, so you can see that on the S&P 500, again, we have the support at that exponential moving average, the 30-week exponential moving average. Okay, but the RSI is below 50. Now, I'm going to show you guys something else. Okay, if we just, the S&P 500 tends to be what we call a market cap weighted index. In other words, it's really the companies that have the higher market cap that tends to drive the S&P 500. We can add underneath this what's called the equal weight index. So we look at all of the same companies in the SPX 500, except instead of weighting them by market cap, we give each of them an equal weight. And what we have here is called the RSP. The RSP is effectively an Invesco ETF that's equal weight. Just put it underneath. Okay. And what you can see here is that the equal weight is in worse condition than the market cap weighted. Can you see the downtrend is even steeper than with the normal SPX 500. Let's just put in the peaks and troughs so everybody can see the downtrend. So we'll put in the peak over here. Okay, we'll put in the trough right over here. All right, let's put in the lower peak over here. I'm just going to write LP. And here's the LT. Okay, so what this is suggesting to me is that whilst we have a relatively flattish, not a particularly serious downtrend on the SPX 500, it's actually masking underlying weakness. And that underlying weakness is saying, well, when we stop looking at the big companies and giving the most weight to the big companies, most of the underlying stocks on the S&P 500 are actually doing poorly. That's a bad sign. That means when we look at the breadth, the spectrum, the broad spectrum of S&P 500 companies, they're under pressure. So we're entering the fourth quarter under pressure. We've seen NASDAQ has got a downtrend. We've seen that the S&P 500 has got a downtrend. We've seen that the S&P equal weight has got a very severe downtrend. This is all weakness. The one last index to sort of complete the hypothesis that we're putting together. Remember, we're moving into the fourth quarter next week. We've got to look at the small companies. We've got to look at the Russell 2000. And if we take a look at the US 2000, that's the FXCM CFD for the Russell 2000. The Russell 2000 is a smaller companies index. It's very instructive to look at smaller companies because they tend to be closer to the economy. There are less financial instruments available to them. They just reflect more of the underlying economic conditions than perhaps the large caps do. So take a look here. We were doing quite well on the Russell 2000. We did at one stage have a higher trough followed by a higher peak. Okay. In fact, we had a shift up in the gradient of the uptrend, where you saw that the uptrend speeded up briefly from the black trend line to the orange trend line. But we've got a problem. What's the problem? That trend has now ended. What we can do is we can take out our labels, we can take out our line studies, and we could start from the beginning, and you'll see that there is something unhealthy that's taking place on the smaller companies basis. So let's go through to this screen here, and let's just remove the line, that line. Let's remove the labels. And now, what have we got? We've got something that needs to be monitored. We've got a peak. Okay, we've got a trough. Once we've got these references in, it becomes quite easy to see, well, the next point in the series is a lower peak. Well, that's a sign of weakness if you've got a lower peak. Well, not only do we have a lower peak, we've got a lower trough on the small companies, on a small companies basis. That to me suggests that there is real strain again going into Q4 next week. We've got a very serious technical pattern that has emerged on the stock market, on the risk markets. Lower peak, lower trough on all of the major US indices. But take a look at the small companies. Where is it relative to its exponential moving average? It's lower than that 30-week exponential moving average, and that 30-week exponential moving average has curled down. When we apply the filter of direction, the weakness has been emphasized by the fact that the EMA is pointing down. And then, of course, take a look at our take a look at our RSI. RSI is below 50. So what we've got to pay attention to is the fact that we're going to get third quarter earnings. The third quarter earnings season is going to start in the next few weeks. If we get poor earnings, well, that's going to be a headwind. But keep an eye on the forward guidance that companies give. If the forward guidance is going to be poor as well, that's going to compound the situation, and we could really end the year under pressure on the risk markets. What's the big driver here? Real rates. Those real rates are moving up at levels we haven't seen since 2008. It's putting the risk market under pressure. Well, if the risk market is under pressure on the American side of the Atlantic, what's happening on the European side? And what we're going to use is the DAX as the proxy for the European side. So we'll just take a quick look at the German 30 CFD, which is our proxy for the DAX. It's actually the DAX 30 has been changed to the DAX 40. So we actually just to highlight the point, this is we're looking at the DAX 40 here. Our instrument is still called German 30. What have we got? Lower peak, lower trough. Take a look where we are relative to the EMA. That EMA has turned down. And where's the candlestick relative to the EMA? It's below it. Weakness on the European side of things as well. What's happening to the RSI? RSI is below 50. It's in a weak momentum area. So you can see that by and large, the risk markets are looking poor. If you're holding a portfolio, you're heading into a period where there are particular headwinds. Just be aware of that. Now, we'll continue monitoring it. One of the ways that we can monitor it is using our zones. Instead of using the zones on a daily basis, we can go up to other levels. Take a look at it on a weekly basis. And you can see, well, on the weekly basis, we've dropped all the way down to zone 3, just to highlight that weakness. I just want to see if there's any comments that have come up. AR means artificial intelligence. AR. Sorry, I only saw that comment now, Raj. On the left side, you have support. That is true. That is true. Okay. Support is a factor, Kim. There's no doubt about that. But what drives trend is not resistance and support. Okay. What drives trend is peaks and troughs. Okay. If you've got something like this, let's just take a look at paint. If you've got something like this, how am I going to do it? Let me try this again. Like that, like that, like that, like that. Okay. Here's your peak. Here's your peak. Here's your trough. Okay. What's your lower peak? Here's your lower peak, I beg your pardon. Here's your lower trough. That's still downtrend. Okay. We do have support over here. Okay. So that might cause, that can have any sort of effect. It could cause the next lower peak in the series. Could cause the next lower peak. Could cause a trading range. Okay. Could cause a trading range. It could cause it to bounce up. Could cause it to bounce up. But at the moment, if I had to say to you, okay, there's support underneath us. There's always going to be support underneath us. And there'll always be resistance on top of us. If we're looking at trend, we're looking purely at peaks and troughs. What is the trend over here? It's lower peak followed by lower trough. That's flashing a huge warning sign. Does that mean that we're going to go down further? I don't know that. I can't predict. Nobody can make that prediction. What I can tell you is it's flashing a warning sign. If things were rosy, if things were really excellent, why would we have a lower peak here? Why would we have a lower trough here? Okay, that's telling us that there's fund managers that are exiting. Okay, and if they are exiting, where are they putting their money? Well, that's the next part. We can take a look at dollar. So a lot of money. Okay, bar support is a price where buyers come in to buy. Okay, so there's an interesting book called Trading in the Zone. Okay, and if you read Trading in the Zone, there's this one particular point where this technical analyst goes in to speak to a fund manager, and the fund manager says, I think they talking about wheat or something. He says, we're at support, wheat's gonna jump. And the portfolio manager immediately makes a phone call and says, sell another 10,000 bushels of wheat, and just pushes through that support level. It's only an indication, okay? It's not an absolute. So yes, the demand and supply are certainly factors, okay? But they're not absolute. The idea is get an idea of what the primary trend is doing. In my view, get an idea of what the primary trend is doing. Then look at the support levels and the resistance levels on the lower time frames that support the primary trend. Okay, so there's no absolutes here. Go and get that book, Trading in the Zone. It's by a guy named Mark Douglas. It's a really insightful book. I found it not the easiest book to read, but it's extremely insightful. All right, let's take a look at US dollar. US dollar is in zone 1. Okay. As there is pressure on the risk markets, the dollar as a safe haven benefiting. As real rates go up and put pressure on the risk markets, it's supporting the dollar. Let's have a quick look at gold as well. And gold starting to feel the pinch. Gold starting to feel the pinch. It's let's go down to the daily here, and you can see. Look how we've broken through the support level here. Here's support that's broken. Support, broken. Okay. Why is it broken? Those real interest rates are driving the market. It doesn't matter where the technical support and resistance are. We want to marry the technicals with the fundamentals. Okay. Yeah, you can see that the expansion of gold is to the downside. That's a push. It's pushed below this support level as well. Okay. We're really technicals are, I'm a technical analyst, but it's so much more powerful when you actually look at the technicals with the fundamentals. It's going to make the analysis so much more succinct, so much more insightful, so much more sensical. If you go through to the weekly chart here, here's that support, but here was the trend: peak, trough, lower peak, lower trough. Well, this is the next lower peak. Okay, that's the next lower peak. And here we've got the next lower trough. It's a very shallow downtrend, but it is a downtrend. Okay, and it's playing silly buggies with the support levels. Just need a bit more on fundamentals, Russ. James, the idea, we are absolutely covering fundamentals in this webinar. It all starts with those rates, and remember the key question: how high can they actually go? Raj asking, how did artificial intelligence influence the NASDAQ? Companies that are starting to utilize artificial intelligence really caught a bid. Nvidia, I think, jumped by almost 300%. It's kind of the next and when I say evolutionary step, we're talking about a giant evolutionary step in the tech sector. It really is changing everything, Raj, and can really benefit the top line. And if it benefits the top line, well, the share prices were reflecting that. All right. Any other questions there, guys? Any other questions? If we keep away from the US dollar, should we look at cross pairs away from the US dollar? You can definitely look at cross pairs. Again, you're not going to escape fundamentals. You're not. You have to know your fundamentals. There's just no escaping it. So let's just say you're looking at euro pound. Well, what's happening in the relative interest rates between the euro pound? Okay, so you've got to investigate that. So what you can do is you could go back to TradingView. You've got to try and come to an understanding of what's happening between the ECB and the Bank of England, and then just to start off with, go 2 year minus 2 years, so the different regions 2 years, okay, and see what's happening here. Okay, so here, put in your peaks and troughs. Put in your peaks and troughs. Trough. Peak. Higher trough. Higher peak. And now we've got to see if that's having some sort of influence. The trend over here, it's not, it looks as if it's just starting. We have hit that 30-week exponential moving average, which is acting as resistance. Let's put in the euro pound underneath. Okay. It's quite tricky, but maybe something like that. So it looks as if the spread has an effect on the euro pound as well. Can't get away from fundamentals. You've got to embrace it. That's really it's going to make your trading. It's going to take it to the next level. All right. Any other questions there? All right, let's conclude at this point. Thanks very much, guys. Have a great day ahead, and good evening. We shall chat tomorrow morning. Thanks very much, guys. Have a great day. Cheers.